Good morning, everyone. This is Lin Sin, covering the consumers and healthcare sector. So today we will be featuring our latest initiation on Zhongming Baihui Retail Group. Thank you. Yep. So this is just a snapshot of the counter's past 1 year price trend. We initiated with a buy call with a 12-month target price of $2.10. It previously closed on last Friday at $1.78. The target price implied a 21% upside, inclusive of the 5 cents dividend that we forecasted. This chart is just to showcase how stable Zhongming Baihui's stock price is and how resilient it is as compared to the STI index, compared to its small cap index, where it is actually a constituent in this small cap index, as well as the China top index. I also made a comparison on the consumer services index, such that you can compare against its Singapore retailers. As you can see that it actually outperformed all the indices here for the year to date. Yeah. Okay. This is a summary on why we favor this stock counter. It's actually a resilient Chinese retail play. Secondly, it has a very well market penetration as well as positioning. It has zero debt and a strong cash position. And these three are the near-term potential catalysts that we are positive on. As such, we would like to reiterate our buy rating. And this forecasted target price is based on this DCF. Just to touch a bit on the very supportive macro environment backdrop. Although that a lot of investors have been refraining to invest into the China market. However, we cannot ignore that China is actually one of the most competitive emerging markets globally. And Fujian is actually one of the provinces with most growth potential. From here, you can actually see that Fujian has the 6th highest GDP growth in China on prefecture level last year. It grew at about 10% last year. Despite that, China slowed down to 7.4% in overall basis. And as you can see from here, it has a growing population trend, a rising middle class, and affluent consumers. All of these three factors will translate to a more robust consumer base, which will support this retail play. Furthermore, as you can see that although that that a lot of market observers are actually monitoring the China slowdown, but in the consumer market, you can see that consumer sentiment as well as retail sales are still buoyant. The retail sectors remains quite resilient, and we are actually expecting more favorable initiatives and policies from the Chinese authorities, in a sense that China is actually currently trying to rebalance its growth model to a more consumption-led growth model. These slides showcase where the store locations are for Zhongming Baihui. As of last month, it actually has 12 stores, 4 managed stores, and 8 self-owned stores. Those in blue, in blue and in italic font are actually the stores that we are expecting it to open as of end of next year. And With the opening of Quanzhou Quangang Zhongxing store, we also will be expecting the Quanzhou Quangang store to close then to close by then. Later I will elaborate furthermore on why. And from here you can see that most of its stores are actually located at the sea line, where it also offers a more robust growth. To touch a bit more on why do we think that it has a very well market penetration rate, it has actually about 18 years of experience. It opened its first store in 1997, and behind the scene is actually has a team of dedicated and experienced management team whom are actually conversant with the consumption pattern and the daily activities of Fujianese. All these actually contribute to its strong brand equity. It's ranked number 18 last year in the top 50 chains in Fujian province. If you Actually, these top 50 chains consist of other retailers such as garments, sportswear, electronicals, appliances. So stripping out all these sectors, only in the supermarket category is actually ranked number 3 after Yonghui Superstores as well as New Huadu Supercenter. Secondly, uh, the the group actually uh, has a very good eye in picking its store location, in the sense that is either located at the heart of a residential area or at the crossroads of traffic flow. So just to give you an example to illustrate that, it will be its flagship store in Xiamen Wuchun, which is actually an underground shopping area. This underground shopping area is actually touted as the largest of its kind in Fujian province. It has 12 entrances leading to the 412-meter long underground street. So uh, this underground shopping area is actually located under the Xiahe Road. It's a network of walking paths and underground pedestrian crossings where it links shopping malls on both sides of Xiahe Road. So if you need to cross the road, then uh, you have to cross it via underground because there are no pedestrian crossings or um, overhead bridge on the ground. So all the pedestrians will be forced to go into the mall. And this shopping area is also a transit to the 3 major public transportation in the city. Firstly, the bus rapid transit station, then the Xiamen railway station, and also it's the Wuchun long distance bus station. So um, we can see a very high traffic flow in this particular store, and it actually will translate into a high eyeball count, which will underpins the demand for advertising space and also account for another source of income for the group. In addition, we can see there's an interesting tenant mix, which will help to increase store hours. For example, it actually adopts the retailtainment concept, where it offers a one-stop family-friendly shopping center, offering daily necessities, jewelries, and entertainment center. For example, eateries, cinemas, and even indoor and outdoor children playgrounds. It also houses pretty good mix of local and foreign brand names, providing wide range of varieties to consumers. So according to the group, the average occupancy rate is at around 95%, where empty areas are usually temporal due to change of tenant, and it may be in the midst of store renovation. The group also organize group activities in front of the store space to attract crowd as well. Another differentiation of the company is that quality, quality and safety assurance is being made a, a priority for the company. As you can see from here, they actually do some they actually do daily checks on their fresh foods to ensure that it actually meets the international ISO standards. As you know that food safety has actually been a long outstanding problem that haunt the Chinese consumer market. The group has also partnered with an e-commerce platform as a pilot to test the waters. As you know that e-commerce has been a very growing and has been hitting the physical store retailers. So this tie-up will actually be managed by its partner and is targeting to serve customers within a short distance of the Nanjing Nanzhan store. However, it's still currently in a gestation stage, so we might not be seeing a lot of revenue flowing from this initiative. Now we shall look into the drivers of the company. They actually derive income from four main sources: direct sales, which comprises the supermarkets as well as the jewelry store. Secondly, commission from concessionaire sales, where it actually charge um, a certain percentage to the concessionaires, the aggregate sales from its concessionaire at a average rate of about 21%. Thirdly, from rental income, and lastly, from a managed rental. It also derive other sources of income from fixed management fees from the four managed stores and advertising and promotion fees, as mentioned earlier. So the group's diversification strategy actually pays off amid a nationwide economic slowdown and keen competition landscape. It actually helped to record, as you can see from this chart, it actually helped to record a better overall margins as compared to its pure supermarket peers, despite that from here, the light blue line, it has recorded a lower direct sales margin. So it implies that the other value-added services from other segments, particularly from its concessionaire sales, helps to lift its profitability. This diversified portfolio also helps to cushion the group's top line while it expands and nurtures new stores. It provides the business mix flexibility for the group to weather various challenges, adding to its business resiliency and competitive edge. Next, let's look into their financials. So from 2011, you can see that revenue grew from about 200 million renminbi to about 900 million in 2014, recording an impressive 3-year CAGR of 42%. However, for PetMe, it actually only recorded a 18.5% CAGR during that period. This is due to the slower sales activities in Xiamen Zhongshan as well as Nanjing Zhongshan stores. So identifying the laggers, the group has actually commenced a series of cost savings measures to improve its profitability. First, it actually implemented staff cost management to simplify management by reducing layers of management. They also redeployed experienced staff to nurture new stores. Secondly, they are also trying to reduce operational loss by closing down one of its laggers, Xiamen Zhongshan store, in mid of this year. And they have also changed the sales mix in Nanjing Nanzan store last year. So about currently they actually leased out about 50% of its gross floor area in that Nanjing Nanzan store. So this would actually cushion its revenue stream from the store and reduce its operation losses. So with all this, we are actually expecting a 6.8% revenue 3-year CAGR for 2014 to 2017, which is actually in line with the moderating Chinese economy growth to below 7%. So the top line growth will be driven by the 5 new stores and the 30 basis points improvement in their gross margin, as you can see from here. So eventually all this will trickle down and translates to a 26.5% net profit CAGR for the same period. We also expect that the group will continue to generate strong cash flow. However, as the group does not have a fixed dividend policy, but it has actually made its first dividend payout in 2013. And being cash rich, we expect that the Zhongmin Baihui to continue to fund its capex internally and should be able to sustain a payout of about 70% of its earnings to reward its shareholders. Next, let's take a look at the peer comparison. So on the valuation side, we actually currently Zhongmin Baihui is trading at about 49.4 times PE. This is somewhat similar to its Chinese peers, but slightly higher at the higher end to the average of the greater China and Hong Kong peers. However, we expect that the P ratio would further normalize to about 25 times by end of the year. This is due to a higher 2015 earnings, and this will be more consistent with its SGX listed peers. With the 25 times P, it will reflect a discount to its Chinese peers due to, firstly, smaller market capitalization, and also due to its single province concentration risk. So just to touch a bit on the potential catalysts in near term. Firstly, would be on the 5 new stores that are in the pipelines and expected to be operational by end of next year. There will be 3 bigger stores, one in Putian and another 2 in Quanzhou. Let me bring you back to the slides in front. Yep. So the 3 bigger stores will be at Putian Xianyu store, at the Quanzhou Quangang Zhongxing store, as well as the Quanzhou Anxi Xingchen store. They have also recently signed 2 leases for smaller stores, both also in Quanzhou. So they have yet to disclose on the specific location, but these 2 will be relatively smaller as compared to its other stores. And because that the management is currently quite cautious on its expansion plan due to the backdrop of uncertainty, it's actually redirecting its focus to into its supermarket business. So if you continue to expand relatively smaller outlets, which are most more cost effective in that sense, where they will incur lesser capex and shorter startup period. Smaller stores will be able to reach out to more localized population segments as well, and it will help their brand name to grow, as well as to boost sales per square feet and sales turnover. So for the Haichang JV and the Nanjing Nanjang store, these two are actually deemed as the group's strategic move. That which means that they are actually good locations with attractive intrinsic value. So the 30% stake on the commercial complex in Haichang JV is because that this district is located in free trade zone. So preferential policies would make it a desirable business hub. The commercial complex is actually currently under construction and is mainly for rental purposes. So the entire project will have a total gross floor area of about 100,000 square meter and is being divided into 3 phases. The completion will introduce a new stream of recurring rental income to the group. As for the Nanjing Nanjang, is the first store of Zhongming Baihui outside the Fujian province, and is located within the development area of Nanjing Ningfa Commercial Center, where this area is a particular development area where the Nanjing local government aims to create a one-stop shopping paradise of over 4 million square feet. So they are something similar to they are trying to build something like the Orchard Street. However, the sluggish progress of this development has actually caused the group to experience some operating losses. Nonetheless, post-cost rationalization and rebalancing sales mix, as mentioned earlier, they have increased their rental income segment. This should be able to help to elevate the group's financial performance, and we should be able to see Nanjing Nanjang store to turn around in near term. This is just to touch a bit on some of the investors' concerns in relation to the interested party transaction. So as you can see that this is the group structure for Zhongming Baihui Group. This Quanzhou Zhongming Baihui Shopping Corporate Limited is actually its sister private company. So it's the parent of the 4 managed stores. And here is actually the shareholding structures of this sister private company. So pre-IPO, Zhongming Baihui actually has 6 managed stores. And in 2013, it has actually made a pledge to XGX when it transferred from the catalyst to the main board, saying that we are going to reduce interested party transaction by ceasing to growth its managed store segment, and they are going to eventually transfer or wind down all its managed stores. So as we can see that in 2013, they have actually transferred 2 stores, one from Tumen and another is the Transhill stores. These are actually a testament of the group's effort in minimizing a potential conflict of interest, and as well as honoring their pledge to XGX. They have also indicated its intention to wind down its Quanzhou Quangang store once its new Quanzhou Quangang Zhongxing store is open. So and as well as they are actually considering to wind down one or two more stores after their lease expire. So these continuous efforts are actually viewed positively as it showcases the management's active role in improving its governance as well as transparency. Another concerns would be on its board composition as well as ownership. As you know that the chairman is a Singaporean and the CEO uh, is Chinese, and its major primary operations are all based in China. So as you can see from here, the by the board itself is quite balanced, where there are where it comprises four Singaporeans and four Chinese nationals and nationalities. And for the insider uh, ownership of the outstanding shares, the shares outstanding, the ratio of Singaporeans to Chinese maintains at 2 to 3. There's no significant paradigm shift over the years. So last but not least, I would like to touch a bit on the key risks to this counter. As we know that the industry is facing keen competition from local as well as foreign players, and there might be some execution risk in terms of the group unable to find a good location, unable to renew its lease with favorable terms, and there might be disruptions work, for example, construction works around the area that might disrupt the stores operations. So all these will be related to the execution risk. Thirdly, will be on currency risk, in particular the renminbi to Sing dollar. However, for this risk is actually quite I'll say quite limited in a sense where uh, the main operations it earns in renminbi, and it also procures in renminbi. The only time when it incur HGD costs or it incurs the translation risk expenses or foreign exchange risk would be when it repatriate its dividend to Singapore, as well as the operating expenses in its Singapore main office. Fourth would be on its the costlier labor and rental cost trend. This might weigh on its margin, and other risks would be from coming from the demand side. So just to conclude my presentation, I would like to reiterate our buy call with the 12-month target price of $2.10. And we are still positive on the Chinese consumption growth story. So as you can see from here as well, that the stable stock price is actually also a vote of confidence from the investors to the Chinese economy, its consumption story, the company's business, as well as the company's management. So if you would like to look into a proxy to the Chinese retail play, then you might wish to consider Zhongling Baihui. So yep, that ends my presentation today. Okay, there's a question on slide 12 regarding the one-third policy. So what's this one-third policy about? So the group actually has this direction where directive where all grocery inventories must have shelving lives of at least one-third of its usable period. So this means that from the time it's being manufactured to its expiry date, it must have at least one-third of this usable period. So for those goods that do not meet this criteria will be taken off the shelf and returned to the supplier without any penalty charges. There's another question regarding competition from internet stores. Yes, the group actually acknowledged that and also acknowledge the potential in e-commerce business. Hence, is as mentioned earlier, it actually had a partnership with e-commerce platform called Beijing 19 e-commerce corporate limited as a pilot program to test the waters. So, however, it did not due to the lack of economies of scale. That's why they have actually sought to partnership in terms of exploring this e-commerce channel. The management also has the view that customers' emotion plays a critical role in retail experience, like senses, the ability to see, to feel, to try, actually enhance customer satisfaction. So as such, e-commerce can only be another distribution channel, and it will not displace retail shops. And also, you can see that a lot of e-commerce companies are actually moving their shops from internet into the physical realm. They are actually setting up showrooms and brick and mortar shops in that sense. Yeah, so for this case, exploring into having a partnership in with an e-commerce platform actually suits the model for 中明白会.
Hi guys, the Hong here. Alan, you have a question. Your question on comparison between BHG Retail REIT, the upcoming IPO, and Zhongming Baihui. What is the comparison like? Actually, a better comparison to BHG Retail would be CRCT, the CapitaLand Retail China Trust that we have under our coverage, because Zhongming Baihui actually operates more like a departmental store operator as compared to versus like a mall owner that collects rents. They do have that portion as well, but it's the main business is still an operator of departmental stores. So as for the comparison between BHG Retail and CRCT, we should be coming out with a short note later this week. So you can look out for that later on in the week.
Hi, there's a question on regarding Metro as a comparison to Zhongming Baihui. So yes, I agree that Metro has some stores in China, but it's not a direct pure supermarket comparison as compared to Zhongming Baihui. So Zhongming Baihui, yes, it does have departmental stores, but the larger portion will be coming from its supermarket. So if you're looking at uh, peer comparison for Zhongming Baihui, probably you might want to look into Yonghui. And actually Zhongming, because Yonghui is a pure supermarket play, but for Zhongming Baihui, it actually has a very flexible business mix. So this actually adds to its competitive edge in the sense, as mentioned earlier in these slides. It has a higher overall gross profit margin as compared to its Chinese and Hong Kong pure supermarket peers. If you're looking at pure supermarket only, Zhongming Baihui actually has a lower gross profit margin, as indicated by this lighter blue line. Okay, since there's no other questions, we shall end our webinar. Thank you for dialing in. See you next week on the same time. Thank you.